Bruce Fraser, welcome back to Face.
Dale, thanks for having me.
You know,
Gosh, I was enthralled. It's like I didn't want that to end.
what this
Yeah,
coverage of
yeah,
the
no, yeah,
CPI?
yeah. It's like what a day to have me on. Jeez.
Yeah, well, it's a great day to have you on because
Oh,
we were getting a little bit micro here, and Wyckoff
yeah,
makes you have to use a telescope.
yeah. My time frames are a whole lot different, so I'm just warning everybody now. But
Okay, Bruce, your work is elite, and if you share your screen,
you got it.
we appreciate you bringing in whatever you bring to us, always edifies us. So looking forward to what's top of mind for you.
Well, and hello to everyone. And Dale, it's just so great to be here. I always have a great time. We're kindred
Thank you, bud.
spirits. I have a chart just for you, Dale.
Okay.
Yeah,
The
in a
point and
minute.
figure.
But this one here is now, it's like I don't trade currency. I just look at the UUP, but I think currency is very important.
Yeah.
So this is the US dollar index, and you all were talking about that. And
Yeah.
I actually am of the mind that gold really is not so much a function of inflation as it is a function of currency chaos. And
Okay. As a monetary
so
metal.
absolutely. And it really, I think that we could honestly say that we're in a period of monetary craziness. But the chart here on the right, the UUP chart, the vertical chart with the uptrend. I just
Yeah.
want to remind everybody that Dale and I talked about this chart right when it was throwing over the top there in September, October. And so we looked at this very chart at that time, talked about it being overbought, throwing over. I call it a trifecta
Yeah.
because what we had is we had a throw over of the uptrend. We fulfilled a point and figure count, which I don't have that count on here now. And then we had a climax, very dramatic climax that occurred right into the end of the quarter. End of the quarter is so important. So all of these things happen, and Dale and I were talking about that right here. And then you can see what subsequently happened, which was that the UUP or the dollar index just cascaded down and out of that uptrend.
Yeah.
Incredible volatile period.
Got from A to B in a hurry.
Got from A to B in a hurry. And then what I've done here is I put the gold futures continuous contract underneath just to really illustrate the idea that gold really is a currency based commodity. And you can see that there's really a kind of a mirror image here of gold to the dollar, but the difference being that you can see that gold actually was stronger at the bottom, in the bottom of this downtrending channel, while the dollar was in an uptrend. The dollar threw over the top into a climactic overbought condition. Gold did not get to the bottom of its channel at the same time. Actually, you could see that volatility was diminishing, something we really look for in Wyckoff. And so you could see at the October lows, and then on the test at the November lows, that it was just crowding up against what they call an overhanging supply trend line, that green line. And then it just came screaming out of there. And so here we can see that gold is now actually stronger than dollar is weak, because you can
Yes.
see the dollar is trying to go back down to the area of support, the January lows. But in fact, it has not taken out those lows where
Well,
gold
gold
has
has made
taken
a
out
rise.
its highs. Yeah.
Great observation. So does Wyckoff really talk about comparing things on relative strength, or this is just
Oh,
something that
no.
does?
Very,
This is your
very,
work.
very big on back in his day, because he was like late 19th, early 20th century. They didn't have relative strength. It's like relative strength. The way that they did it is they did these kinds of comparisons.
Okay.
And this trend line analysis is very much a Wyckofffian technique for trend line and trend channel construction. It's amazing how well it works. And look at how the 2 points that you draw this dollar trend line on, the February and the March lows of 2022, look at how that set the stride for this whole move up. I mean, just think how important those two pieces, those 2 points underneath the dollar defined the uptrend that went for most of the year, as was the case for the downtrend in gold. So really valuable methodology technique. And so
Well, it's a Biden rally.
yeah, right.
Everyone thought the dollar was going to get killed under Biden. Still could.
Well, it still could, yeah.
But it had a great rally. Someone
Yes,
once
it
told
did.
me that the dollar does better under a Democratic administration.
You can see over here on the left, Dale, that you could take that distribution count and count that, and you see here where I actually just took that chart and added some data there so you could see what happened. But it became range bound as soon as it got into that count area. Now, this whole area where it's been in a trading range could be redistribution for another leg down. And I just think it's, not quite ready to commit. I mean, it could go either way. That's the thing about a trading range, but we always sort of think of a trading range as primarily a continuation.
Well, you
pause
have
and a continuation.
You have a lot more red boxes than black compared to at the top.
Very good observation. Yeah, absolutely. And so, and volatility is increasing as we go through there. And the volatility, as you point out, is on the downside because of the red. And that is not typically a sign of accumulation. That's a sign of redistribution.
Yeah, I was thinking there could be one more flush. You know how markets like big round numbers, like par?
Sure.
I'm talking Dixie. So, take that out. And let me ask you, do you think about what we're hearing and the noise in the background at times too, Bruce? Like, I've never seen as many articles about de-dollarization for quite some time. I mean, there were, pop singers that wanted to get paid in euros at times, and a McDonald's ad that says the dollar is low. I remember that. They marked dollar bottoms. Do you think that we're getting close to that in sentiment? I mean, even people who aren't in the business will ask me, Dale, what's going on with the dollar? Is there anything I should do? What's your impression?
Well, no question. And of course, what they're seeing is the explosion of the Treasury's debt burden, 31 trillion, something like that.
They don't look at that. They don't look at that. The people, my barber.
You don't think they're concerned about the immense amount of debt? Well, it could be.
I think they're just
I look at that and I worry.
Right. That's what pros do.
Pros. Yeah.
Anyway, but a lot of people without a lot of market knowledge are being peddled fear about the end of the dollar right now. It's happened before, but it's happening again.
And so I don't know how that translates into trading per se, but I do hear a lot of conversation and read things about that. And I think that this seems to be, the more that the dollar is weak, the more that imports inflation into our economy too. And so if the dollar does continue to weaken, as it has in that last chart we just looked at, we can expect that to translate. And I don't think people necessarily make that connection either, but it's, weak dollar, it does import inflation. So
everyone write this number down, 1841. Because Bruce, what's great about this interview, I see you're that 1841 on the right hand side.
Yeah. Sure.
And using different methods, that's where I want to be a buyer.
Well, that's a 20-month moving average right there. And
Okay.
this is a chart that I've been publishing now since August of 18. I put it in a blog when gold came down to that key support level. And I put there August. And by the way, anybody can go in and read my blogs at stockcharts.com. They're not behind a paywall or anything. Just, go check them out and you could read this. But at that time, I was making the case that we were having a white coffee and last point of support. But really the key point I want to make here is that we have massive resistance up here at the 2011 highs. And also we can see where the 2020 highs were also turned back by the 2011 resistance. And here we are again. And I suspect that we could spend time here. I think that the bull, and these are monthly bars. So this, we could spend a few months here, but the bullish thing that would happen is that we just get real dull and quiet like we did the last 2 months, and we just stall here and we don't come back into the structure. And that would be, I think, very bullish for gold. And the contrary to that, to return back into the trading range with volatility would, really say that, this gold's really not ready to go anywhere. If anything, it might even go down.
The prior peak, so maybe people are going to be they'll look at this chart and go, well, last time gold went from almost 2,100 to 16. But to me, the character of this rally says it's just going to be a pullback, a fraction of what that decline to the left. Even the other one from the high in 2019, that kind of decline.
I'm
But
completely with you.
I think 1840 is possible if the dollar can reverse from lower levels.
And sort of a Wyckoff rule is 50% or less retracement. Getting back to that 1841 would keep this in the top half of that trading range. Now that yellow shaded area right there is a point and figure count. And so here's that count just to give people an idea of potential. It's not a prediction, it's just a potential. And here we are, we're back above 2000 at this area, and we could spend time here, and the count may grow larger if that can happen. And so if it can stall in this 2050, 2075 area and stall and not pull back very much, or maybe get back to that 1840 area that you're mentioning, then this count will grow bigger. But right now, just the count as we see it, very conservative count on my part, 32 to 3,400. And but we need to take out 2075 and we need to stay above it. And then, so we could be having a conversation about this in 6 months, be pretty much in the same spot. So
okay, interesting.
Last thing, gold miners, just to show a trading count. It's like I don't spend all my time just looking at monthly charts, but this is just a working. These shaded areas are point and figure counts that I've transposed onto a vertical, so you can see how beautifully this distribution count in green counted down to the area of the lows that we just talked about, September, October. And now we have a count here that counts up 35 to 40. We have now fulfilled the minimum count objective, but 40 takes us back up to the prior highs from April of 22. So that wouldn't surprise me if that wasn't possible, just from a trading perspective. But in the time that we have, I know we're running out. But
no, that's a nice chart. That might be a nice, if there is a pullback. 31. 31-ish.
Yeah, and then potentially the count could be arguably bigger. It could pull back. We could count from the March low over to, say, the May 22 low. That could be a bigger point and figure count that might become available to us. This is a chart I wanted.
Long-term bulls that have a 70 target.
Yes, well, and if we break out in that monthly chart we just looked at with that point figure, and we can break out and go up to those higher objectives, I would say that's very possible.
Okay.
Maybe, yeah. So
on the
now
knife's edge. Wow. Okay. All
well,
right.
you'll remember the old. Yeah.
Go
Go
ahead.
ahead, Dale.
No, it's all right.
I was
I'm
just going to say, this is a play on words, because as Dale and I remember, there used to be a very popular futures contract on the New York Composite.
Yeah. The knife. Yeah, I
The
forgot we
knife.
used to call it the knife.
Yeah.
Many have
Yeah.
fallen on the knife. Is the market about to get cut loose from people finally starting to realize the old paradigm of a Fed put isn't there anymore?
Well, this is kind of part of this chart, and again, I apologize for pulling up another monthly chart, but
I love it.
So Dale and I were like floating into the business around these first two arrows on the left in that area. This is the reality we dealt with in our careers.
I'm looking at my whole life on a chart, my whole career on a chart.
Yeah, exactly. Me too. And
I fade. It's okay. I hope it was less painful for you, because I faded it all the way up.
Well, I could tell you lots of stories.
Anyway, I didn't just buy the spider and ride it for 50 years. Anyway,
yeah, right. So, well, wouldn't that have been a good idea?
Some people did it. It was just simple. Just buy an ETF.
I did know some of those people. Yeah.
Yeah.
And just pointing out, you can't see it on this chart, but in 1971, Nixon closed the gold window. And that was literally the end of the gold-backed dollar.
Right.
And so and of course, we know what happened, and we talk about currency being a tumultuous thing. Well, if anything was tumultuous, I was on an airplane. I won't go into detail, but I was on an airplane flying from New York to Frankfurt, Germany in 1971 at the very time that they closed the gold window. And I landed in Frankfurt, and the world was a normal place when I left New York. And when I landed in Frankfurt, the world was in chaos. The dollar was trash. It's just, the Europeans were just like hated Americans for, closing everything was just tumultuous. And that was one of my early experiences with currencies.
I really can't remember that period with clarity. But you bringing this up, Bruce, I know this might be a little off track for you.
Yeah.
But don't you think the biggest monetary story of our lifetime is happening before our eyes with a CBDC? Isn't this as big or bigger
and
than
who
Bretton
can know,
Woods?
Right?
And why is it coming? Why is it called a central bank digital coin when our currency says it comes from the Treasury?
Oh, very good.
So it's kind of like a takeover.
Well, and also they're talking about being able to have people transact business without doing it through banks.
Yeah,
doing it
the
through
Fed will be the
directly
bank.
through the Fed. Yeah, that'll be
the bank. They're the bank.
Mm-hmm.
Doesn't it almost make this banking crisis look intentional?
Well, you never let a crisis, banking crisis go to waste.
Okay. Anyway,
to paraphrase.
Yeah.
But
so what's this last chart implying? Are we topping out here? Are the melt up people going to be right about 6,000 S&Ps?
Well, so just to orient us on this chart, 74 low and the 82 low are the classic two. Look at this, drawing the demand line under the market off those two lows on this log scale chart. Look how beautifully that demand trend line worked right to the present.
Yeah.
And every single time we've come down and touched one of these, either the trend channel or the demand line itself, the lower line, it was economic crisis. We were in and each one of those cases, the Fed stepped in and went to work trying to reliquefy the system after a tight money environment situation and to get the economy going again, which got the stock market going.
Right.
So we can see the stress right in the chart and how there was attempts to break through the demand line, but V bottom reversed off these periods and got right back above it because the Fed was helpful. The reason I put this last line on the right in the last arrow in yellow is because the Fed here is basically so far just saying, I think the Fed, the last rate increase they did was the last one for this year. That's just, I have reasons for thinking that. I can't get into it today, but at a later date. But I do think that the Fed is basically done. Powell has said we're not going to lower rates again in anywhere in 2023, and so we could very well see rates just steady at these levels for the rest of the year. And but look at what we have going on. We have a Fed that is not accommodative. They're not stepping in, at least that we can see, and trying to support the market here as they did in 2020, 09, 03, 82, and so on. And so the Fed's whole posture is really related. Now, this is through May 2nd, so you can get a little more detail on the very edge of this chart on the right. But and here's kind of where we are in a blow up on the right side.
Like a failing rally. It was a failing rally this
now
last push up.
I think the analog that we're dealing with, Dale, is the late 60s, 70s period when inflation really took off.
And we have a range in the Dow from 1,000 to 600 for 20 years?
Yeah, exactly right. Yes. And so here we are. Let's see if I can draw. So I believe it's possible that we could be, this would be a bullish case. Would be to have this go sideways. And the bearish case would be that it goes more like this. And we have support at the 2020 lows, maybe here, possibly here. And this is because of the Fed. The Fed is now dealing with ramping inflation. I mean, today, inflation 4/10, I guess it was. And so the Fed's got a serious problem here, where this whole period, when we were like the arc of our careers, the inflation was diminishing after Paul Volcker. And we had inflation coming down every cycle. Every cycle, it was getting less and less and less on our way through. So that's no longer the case. And this is all coinciding with where we are over here.
What a great presentation.
So that's just one that I wanted to show you. And then I don't know how much, we may be out of time, but I did hear a conversation about talking about the bonds. And my career, I worked with Martin Pring and we still are very close. And he characterized the business cycle as having 6 stages. And I'm not going to I can't get into the 6 stages today, but we've been in a bear stage where all the asset classes, bonds, stocks, and commodities have all been bearish, and that's this yellow shaded area. But I believe that we've gone into stage 1, and stage 1 is defined, in this case, we'll look at bonds over here, that bonds go into their new bull market, which I show here is October of 22. And that this is TLT as a proxy.
Got it.
But
so bullish bonds, maybe they finally act as a haven. If we have turbulence in equities, or does it help the equity market?
It should eventually. Well, typically what happens in a classic business cycle is that you have a low here, September, October of 22. You'll typically get another lower low in stocks. You don't have to, but we may return back down here, but you can't get another lower low. But that could come later in the year, early next year, something like that. And if the analog of the 60s and 70s holds out, we could rally all the way back to the prior highs and then still go down and make a lower low in a gigantic trading range. And so I really think that's possible. And but the whole time, because of inflation, we're losing purchasing power.
Okay. I'm looking for a July meltdown. I don't know what it has to do with debt ceiling that people are cavalier about, geo.
Well,
banks, you know, there's so many things bubbling on the oven. I guess they could all be bricks into the wall of worry that the market climbs, but I think there's a puke job coming, Bruce.
Well, you know, you've always had really good instincts, and I just want to say this one thing. This is just a seasonality chart that I created. And by the way, our seasonality guru, Dimitri Speck, is going to do a free webinar for ifta.org, which is the big international Federation of Technical Analysts, completely free. Go register, join us. And but all I've done is I've taken the years that are pre-election years. And so these are all the pre-election years going back 73 years and just showing the seasonality of the pre-election year. And look at, there's really definitely a family resemblance between what is going on with the NASDAQ and seasonality, but we get a little weakness into the mid part of May, and then we have a rally into the end of the second quarter into July right here, which kind of fits with your scenario, and then that trading range for really the rest of the year. But you could be right. You could be seeing what you're suggesting could happen could very well be the way this works out. And so
I've been wrong a million times, but
yeah,
you know, I
both.
just you know, I can, if that 4,200 level is universally embraced, we get a rally over 4,200, everyone will be bullish. So
right.
We'll see what happens. But Bruce, I really opened my eyes to a few things I wasn't even thinking about, and appreciate your point of view, and never apologize for showing monthly charts ever again. And that's in order.
Oh, well, I just wanted to.
Don't get defensive over being, you know, looking at the big picture. Okay. Everyone needs to do that.
It's such a joy to hang out with you all, and thank you all very much for having me.
Yeah, and you could follow Bruce at RD Wickoff on Twitter. You want to let them know where they could, and stockcharts.com. And Albert's asking about that webinar again. He didn't catch it if you posted the link.
Well, here, I can just put this back up real quick. Right here, just ifta.org. And the registration should be right on the home page. IFTA is a great organization. It's 20 country societies around the world, and they're all like technicians, you know, traders like all of us. So
they're all Michiganers.
Yes.
Anyway, Bruce, thanks so much, buddy. I'll catch up with you this summer, and always root for you and the people that listen to your work, that their minds and ears are open, because they have a lot to gain if they are.
Dale, just a blast to be here. Thank you so much.
All right, everyone. Bruce Fraser, follow him on Twitter. Go to that webinar and read what he writes if you want to keep yourself on the right side of the track. And that's a wrap. The team's waiting for you guys, subscribers, in 12 minutes for the Morning Edge. And I'll see you tomorrow for the PPI.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.